Well, welcome back. In today's session, I will I will try to focus primarily on one aspect of the valuation process um, for properties. In the prior session, I went through a summarization of the different valuation methodologies, and I talked about primarily two different ways. The first was how you value a property intrinsically. It's called the intrinsic valuation method. And the second was what I called relative pricing. Intrinsic valuation deals with how you use the fundamentals of a property to ascertain what the property is worth. The relative pricing is an alternative approach whereby we look at comparable properties, in which case there were two options I gave: comparable cost or comparable sales, and the second was the replacement cost approach. For the intrinsic value approach, I talked about a methodology that can be used, which is called the discounted cash flow method. And I said there are other ways, other accounting ways, methods that can also be used. I'm going to begin with the intrinsic valuation approach because I believe it to be the superior way of estimating what a property is worth. And what that means is that if we are going to use the DCF approach, there are a few things, a few concepts that have to be understood. Unfortunately, or fortunately, depending on whether you're left brain or right brain, or whether you like analysis or you don't, this approach requires a lot more rigor to the process, and that requires calculations. I mentioned that the discounted cash flow methodology simply takes into account the value of a property based on the cash flow the property can produce over its entire lifetime or over the entire period of ownership. That cash flow has to be brought back to the present. And the way we do that is by discounting the cash flow. Hence the definition, the discounted cash flow method. Therefore, the first part of the process is to establish what the discount rate is. The second will be to establish what the cash flow would be, and with that two basic sets of information, the final is to establish the time period for holding the asset. So in today's session, I'm going to focus on the discount rate. I mentioned that the discount rate has and can be referred to by several other terms. We can also call it the cost of capital. We can call it the hurdle rate. And we can also infer to it from the opportunity cost. So let's begin, and I'll try to use the hurdle rate to set the scene. And let me explain a few concepts so you can understand where I am coming from. Traditionally, in finance, there is something that we call the capital market line. Please bear with me, but I think if you understand this concept, it would be so much easier for you to understand investing and to understand valuation, but also it would be so much easier for you to appraise investment opportunities, whether you're looking at properties or whether you're looking at stocks, public companies, or whether you're looking at private companies, bonds, or any form of assets that is of interest to you. Let me just explain a concept that I think will be so important and will be so helpful in all of your investment decisions. There is a relationship that exists between risk and return. This relationship exists across all potential opportunities. The relationship varies across different asset classes. In many ways, it varies on a relative basis. The capital market line is a way of representing the risk-return relationship across different assets. And it also shows when assets are in equilibrium or when they're off equilibrium. On one side of the line or the axis, you have return and you have risk. The idea of the perception in the market tends to be that if you want to achieve more return, you must be willing to go out on the risk line and take more risk. So most people tend to assume that assets that are risky also offer higher returns. I'm going to address that as we move forward, but just keep that in mind. The idea is that people hold on to, which I believe to be wrong, is that you have to take more risk in order for you to achieve more return. Therefore, we have something like this as the capital market line. And along this line, we have different asset classes. And as you go up the asset classes, the return promised, not guaranteed, but promised, increases. But likewise, the potential risk increases. In principle, this capital market line imagine that to be 1, imagine that to be 2, imagine that to be 3, 4, 5, and this is 0. And let's just start with that. I think that'll be the best way for you to almost appreciate what I'm trying to share. Let me start by saying this. And I'm going to give different names to each of these. Number 0 is called the UK gilt. Number 1, let's call this a UK investment grade bond. But this is a corporate bond. It's a company bond. Number 2, the UK equities or stocks. Number 3, high risk bonds. Number 4, real estate. Number 5, private equity. So what I've shown you here is different asset classes and how they present themselves on this line. This line we call the capital market line. So let me take you back to 2007. Let's say the month of June 2007. UK gilts, in this case I'm looking at 10-year gilt, the return was 5.75%. By the way, if you notice on this line, the UK gilts has a risk of zero risk. Therefore, if you were looking to buy an investment grade bond of a company, you would expect to be compensated more. So for example, you may have said, I would like to get 7.75, meaning you wanted a 2% spread above the risk-free asset. If you went to equities, you may have said, I would like to get 8.2%. If you went to high risk bonds, you may have said, I would like to get 9.5%. Then you get to real estate, you may have said, I would like to make at least 10%. Private equity, maybe I would like to make 13%. The idea of this is that in order for you to be induced into taking more risk, recognizing that you could buy the UK 10-year gilt risk-free, in order for you to have taken more risk, you would have been expecting to be compensated for that risk. This is 2005. We know in the UK today that the UK Bank of England have started to make changes to interest rates. I'm going to use a rough estimate of what the actual 10-year gilt is today. But let me describe a concept first so that you can understand. In 2007, the UK risk-free rate was 5.75%. We then went into a financial crisis, and what happened was that the risk-free rate was pulled down, and it was pulled down almost to zero. What that meant was this line, which is represented that way, if you pull down all assets, if you pull this rate down to zero, what you then get is a line that looks like that. It's a parallel drop. It doesn't always follow the same parallel pattern. What we do know is it begins there at zero, and let's assume it was pulled down to zero, not 0.1. Let's use 0 for ease of reference. Sometimes the line can be like that instead, or the line can be like that. But the point is that the line is building off of zero. The gradient or the inclination of this line represents the premium that you would ask for in order to move away from something risk-free to a different asset. So, under all normal circumstances, if all assets are on this line, we say that all assets are in equilibrium. All assets are in equilibrium. There are times, however, when a particular asset could be off the line. So you then have something like this. Or sometimes you might have that asset class below, in which case you have something like that. The point being that there is a relationship that exists between each asset class. Investors demand different returns for the risk that they have taken. But the key thing to keep in mind is you should expect to make more as you move down this line or as you move up the slope. Whenever you find that an asset which should be earning more is in disalignment negatively, then there is cause for you to pay particular attention to that. For example, In 2007, we had this relationship. But if properties was earning, rather than 10%, if properties was earning, or if properties on the aggregate was generating a return of, say, 7%, then you would have had a line that was like that. What this would have shown is that properties, you're earning a 7% return, which is less than all the other less risky assets. And therefore, that may have been an indication that the premium being asked by investors is too low, and potentially that asset class could be in a bubble, could be overheated, and therefore you should thread very carefully. So the slope of this line simply represents the risk premium, and whenever you find that investors are taking less of a premium for a highly risky asset in comparison to a less risky asset, that should always be a cause for concern. The line of the slope is the premium, and or rather the line represents the risk premium. The slope of the line expresses investor optimism or aversion to risk. So if this line is low here for properties at 7%, then that indicates that people who are buying properties have too much optimism and less risk aversion, because they're accepting less money than they can get, or they're accepting less of a return for their money than they can get on a less risky asset. A long way of explaining this concept, but I hope you understand that. Now, with that backdrop, let me expand. Let me then bring you back to today's session. I thought this would be a useful way of explaining the process of carrying out the intrinsic valuation on a property or for a property. Now, based on everything I've shared so far, what that means is that in every asset class or with all investments, there is a relationship that exists between the interest rate and the amount of risk that you will incur in the ownership of the asset. This interest rate is made up of two parts. The first is what we call the pure interest rate. This is also called the risk-free rate. The second is the risk premium. This was the slope, the change in gradients in the slope between each asset class, as I described. Put differently, if the risk-free rate in 2007 was 5.75 and UK investment grade bonds, company bonds, was yielding 7.75%, then that would mean that the 2% was the premium and the 5.75 was the pure interest rate. Key, very important point to make. So what that means is that the rate of return that you would demand from an investment should consist of the risk-free rate plus a risk premium. That should give you the interest rate you would earn on the asset. This is also called the hurdle rate that you should expect to earn from your investment. Simple but profound concept to keep in mind in any analysis you're doing on any asset. Always keep that in mind. You always build off the pure interest rate. Now, when the capital market line has been pulled down and you go from 5.75 to 0, what that means is that investors typically have to go out, further out. If this was 5.75% and you pull this line down, that would mean that assets previously that were generating 13%, when you pull them down, now they can only earn roughly 5 to 6%. So the dilemma caused, or the dilemma this causes, is investors have to become slightly more creative, which is where you start to see investors do very clever things within the property portfolio with regards to financing, property development, property management, and property and investment selection to ensure that they can maximize the return that they earn. So keep that basic principle in mind. Now, what this simply means that one of the most important parts of your analytical process when you're valuing a property is to establish what premium you're obtaining for investing in properties. If the premium is less than what you would gain from investing in less risky alternatives, then that could be an indication that that is the wrong time to invest in properties. As a matter of fact, the property risk premium, in my opinion, is how you know whether the market is in a bubble, is how you know whether the market is overpriced or whether the market is underpriced. Now, this property risk premium is not easily obtained. I cover this very, very explicitly in the Ins and Outs book. I wouldn't have time to go through that today. But suffice it to say that if you get the premium right, then you're sure you won't be making mistakes in your valuation process. This overall interest rate, which I also call the hurdle rate, comes in different forms, which is what I will try to conclude today's session with. The hurdle rate becomes the minimum rate of return that you have to earn before you can allocate funds to an investment. Let me say that again. The hurdle rate is the minimum rate of return that you would accept, is the minimum interest rate that you would accept in order for you to invest in a property. This hurdle rate is set by you, the investor. But there is a different type of hurdle rate. So for example, let's say you made a decision that your minimum acceptable hurdle rate was 7%. It would mean that all of your appraisals would have to meet this 7% threshold before you would invest. However, what you should also consider is that although the interest rate and the hurdle rate are synonymous, there's also something called the cost of capital. In other words, if you're buying a property with cash, then the hurdle rate would be the hurdle rate for what we call equity. If you're buying the property with debt, 100% debt, then the hurdle rate would be the cost of debt or the cost of financing. If you're buying with a combination of debt, in other words, you're taking a loan or mortgage plus equity, which is your deposit, then you would then have a cost of capital, which is a weighted average of both your equity funding and your debt funding. We call that your weighted average cost of capital. So these three become what I call sub-hurdle rates that you should keep in mind. What you tend to find is most investors, for example, if you're buying with debt, let's say your cost of debt is 4%, most investors will value the property using 4%. What that means is the property will become overvalued. And when they find a property that can pay for their cost of debt, they accept such a property. On the other hand, shrewd investors tend to allow the hurdle rate to be set based on the minimum amount to be earned if you were buying with cash. In this case, let's use an example, 6.5%. In which case, you would say 6.5% is my hurdle rate if I was buying with cash. Now, right now, I'm not suggesting that you are. But what I'm saying is that if you have two investors buying similar houses, one using cash, one using debt, you always have to appraise the property as though you're using cash. Otherwise, you'll be transferring wealth from yourself to the seller. If Mr. A uses 6.5% and Mr. E uses 4%, Mr. E will overvalue the property and pay much more than the property is worth compared to Mr. A. So the 6.5% becomes the minimum funding rate, in which case he can compare that to his original 7%. Then he can make a decision on an opportunity cost basis. So this is his minimum acceptable hurdle rate. But it could be he values the first property using 6.5% and the property does not meet that threshold. He looks for another property. So on an opportunity cost basis, he would discredit the first property if he recognizes that there is another property that offers 7.3%, in which case he would choose this one as it exceeds the 7% minimum that he wants. I'm going to come back later on and explain why having a very high minimum hurdle rate could be risky, because in principle, the higher you make this number, the less investment opportunities you have. But keep that in mind. The way I tend to approach valuations is I value properties using the cost of equity, or assuming I'm buying with cash. And then if the property meets that threshold, then I can then use the cost of capital comparison against whether there is an opportunity cost. So for example, let me make it more simple. There are 10 properties on the market. I appraise all of them using 6.5%. 6 of the properties fail to meet the 6.5% threshold that I expect. 4 of them meet that threshold. And let's assume the first is 6.5%, the second is 6.8%, the third is 6.95%, and the fourth is 7.6%. What I have created now is a minimum 6.5%, which is my cost of funding, my cost of equity. However, because I have options, I don't have what we call an opportunity cost, which means I don't have to compare one asset against the other. Because my minimum hurdle rate is 7%, I would then say that on an opportunity cost basis, the last property will be the one I get to choose. So in principle, what you're saying is whenever a property meets your threshold, you should look to the best alternative. That is the concept of hurdle rate for equity. I'm going to stop because I think I don't want to overload you with the concept. But keep that in mind, because when I return in the next session, I will go into the hurdle rate for debt and the hurdle rate for debt plus equity. And once I've explained the 3 concepts, I'll consolidate the 3 of them and I'll show you how that information becomes the first part of the discounted cash flow method analysis. In other words, the discount rate. Now, I hope that's been useful.